Hi, Todd Garno here with Three Creeks Capital. Today I want to discuss with you what you can expect from midterm election years, which obviously in 2026 we have a midterm election coming up, from the stock market. Is there big returns, average returns, what's the volatility like, all of those types of things, so that you know what the average or what could be the expectation for 2026. So let's go through these charts. They're very helpful. So in this first chart, you see these blue and yellow bars. On the bottom, the blue represents the drawdown in that year, okay? And then the 1 year return off of that low. Okay, so a year later, what was it like off that low? So let's just pick one for example. In 2010, let's say, you were down 16% that year at the market low. Doesn't mean the market was down that much. It just means at the low with volatility that year, going through a market correction, it was down 16%. And then 1 year later, it was positive by 31. So think about that gap, okay? So, hey, I sold at the bottom because I got a little panicky. 1 year later, the market's positive 31, and you sold on the bottom down 16. Well, that's a huge difference in what portfolio value you have after that correction, okay? And this is what we want you to think about and why you shouldn't panic. In this particular case, the example that I used, you can extrapolate, let's say, some of that data into this year. Okay, what if the market at some point in 26 is down 16%? Can you expect it to be up next year? Who knows what the future holds, but the idea here is we do expect volatility in 2026, okay? Now, let's look at the bottom half of this chart. You can see here, corrections that begin before September there on the left, in the blue down 16, and then up 23, and then corrections that begin after September. Okay, so think of that midterm election time period. What's it telling us? Well, most of these corrections are coming, that are at least are a little deeper, are coming before the midterm. Why? It's uncertain. We don't know who's going to win, what changes are going to happen, are different things going to expire. So all of that uncertainty for the market, it's just hard to digest. So that's why you get all this volatility, okay? Now, midterm years only, we can see down 21 versus all the other years. And in that particular case, okay, well, 21% is a fair amount before September, and then after still 13. Hey, the market didn't like who was elected, right? So that's what you're comparing in those two, which is really interesting. Now, here's what we're telling clients. You see all that volatility up, down, all over the place, right? Well, guess what? Second year of a presidential cycle, what's it say? Maybe average 2% at the end of this year. You get there and you think, wow, that was a lot of volatility, just earned 2%. Again, this is an average. It could be up a lot more, could be down more, right? So the reason why I bring all this to your attention is to, again, become more realistic with 2026 and setting those expectations. This may not be a year like the last couple where the S&P is up a lot and you feel pretty good about your account. This may be a year in which you're just simply trying to withstand the volatility and know that you get to the end of the year and simply don't have as much investment return. That's okay. Not every year can be a great year. If you're worried about how your portfolio is positioned for 2026 in this midterm cycle, feel free to give us a call. We can talk you through this so that you have a better understanding of where your risk may lie and then what that expectation could be for you. Thank you.